So it's another great time, students, we meet for this session. This is Edwin Ochoy. So we have been doing these sessions from time to time from the semester, since the semester started. So for today, I would like to do a small area in group accounting. So because that is where we are for now. So that is on how the parent company is supposed to consolidate foreign subsidiaries. So we will have to solve a question on that. Foreign subsidiaries. So that is International Accounting Standards 21. So whereby you find that, for example, you have a parent acquiring a subsidiary in another country. So you have a parent in Kenya. Then it went ahead to acquire, for example, a subsidiary in Rwanda. So remember that in Kenya we use Kenyan shillings. In Rwanda they use Rwandanese francs. So obviously under consolidation, remember that the parent must consolidate subsidiaries. But now, for you to consolidate a foreign subsidiary, you have to translate the operations of the foreign subsidiary. So we need to know which methods are used in translation of the foreign operations of foreign subsidiary. Then we do the consolidation. So it's all about understanding those steps for consolidation of foreign subsidiaries, a subsidiary which is on a foreign jurisdiction. So in a foreign country, that is in short. There is a note which we need to go through around 2 pages. Then I go direct to solving a question. We talk about foreign subsidiaries. We say that a parent company may do what? May operate a foreign subsidiary due to various reasons. For example, now if you want to meet your customers' needs so that you satisfy those customers, you can get a foreign branch. You can get a foreign subsidiary, sorry. So for consolidation purpose, the parent company should translate the operations of the foreign subsidiary. That is what I was saying, that when doing consolidation, as the parent, you must translate the operations of the foreign subsidiary before you consolidate it. So methods of translation: presentation currency method, also known as the closing rate method or the functional. So when we talk about presentation currency method, that is the one which is recommended. So this method is ideal for translating operations of subsidiaries which are deemed to be independent in nature. Remember, you will find that most of the subsidiaries are independent. Most of the subsidiaries are what? Independent in nature. So the presentation currency method is the one which is ideal for translating subsidiaries of those kind, the subsidiaries which are independent in nature. So International Accounting Standards 21 highly recommends the use of this method because many subsidiaries are done what? I have said they are assumed to be independent in nature. So when translating now, you have operations of the foreign subsidiary using this method. Remember that we have various variables to deal with. That is income and expenses, assets and liabilities, dividends, depreciation, capital and reserves. So you need to know the translation rate for each. So like now, incomes and expenses use the average rate. The incomes and expenses use the average rate. So you need to get this correct, because once you understand the translation rates, there's no question which would be difficult for foreign subsidiaries. It's all about understanding now, when translating this, what am I supposed to do? When translating this, what am I supposed to do? So for incomes and expenses, we have said that to use the average rate. Assets and liabilities, closing rate. Dividends, closing rate. Depreciation, sorry, dividends, it's spot rate, not a closing. Assets and liabilities are the one which we use closing. Depreciation, we use the rate, which was done what? The rate used for non-current assets. Mostly non-current assets will be translated using closing because they are assets. Then capital and reserves, we talk about historical. So how will you be able to identify that this is an average, this is a closing rate, this is a spot rate, and this is an historical? So for the average, you will be told that this is an average. That one will be direct. But for you to know that this is a closing, for you to use it in translating assets or liabilities, closing is the rate which was prevailing on the date, is the rate which would be prevailing on the date when the statement of financial position was prepared or was to be prepared. So meaning that as at the end of the year of that relevant question you are doing. So the closing rate is the rate which would be given as at the closing date. The date when you are doing what? You are preparing your statement of financial position. For the spot rate, that is spot rate, rate which was prevailing on the date of occurrence of a transaction. You will be told that this transaction occurred on this date. Then you will be given a rate as at that date. You will be given the rate as at that relevant date. Then for the historical, the rate which was prevailing on the date when the subsidiary was acquired by the parent. You know that obvious subsidiaries are acquired by the parent. So for the historical rate, you will be given that rate as at the date when what occurred? The subsidiary was acquired. So that is the historical. The one you use to do what? To translate capital and what? And reserves. So that is the case. So the main thing is all about those methods, those rates. We have said incomes and expenses, average. Assets and liabilities, historical. Dividends, spot rate. Capital and reserves, historical rate. The assets and liabilities, closing. Steps for consolidating for a foreign subsidiary. The first thing you do is all about you translate the income statement. Step 2, you translate the statement of financial position. Remember that you are translating the foreign branch. So you translate the income statement of financial position of that foreign branch. Then you determine the exchange reserve arising on translation, because the exchange reserve can be a gain or a loss due to the aspect of inflation. Today, if you translate a dollar, tomorrow if you translate a shilling to a dollar, tomorrow you might find that the dollar is selling at a different value. Now the dollar has been weakening a shilling. So it's at 125 currently, or more than that, to Kenyan shilling, $1. That is a dollar is equivalent to how many shillings? That is. So anyway, so there's that changes which occur during the time of translation due to aspect of time. So that is what you determine exchange reserve arising on translation. Then determine and retranslate goodwill. So you have to determine first goodwill using the foreign currency. Then after that, you translate it. You have to translate goodwill twice, as at the time of acquisition and as at the time you are preparing your books. Then after you are done with that, you prepare consolidated financial statements. So I would like to do a question of November 2016, question 1. So this is a relevant question. So they are saying that H Limited, a public company based in Kenya, owns a 75% of the ordinary share capital of S, a public limited company based in Rwanda. H Limited acquired S on 1st May 2015 for 1,200 Rwandanese francs, when the retained profit of the S were 800 million Rwandanese francs. The functional currency of H Limited is Kenyan shillings. The functional currency of S is Rwandanese franc. S Limited has not yet revalued its assets or issued any share capital since its acquisition by H. So the following financial statements relates to H and S. So you have HS, so the statement of financial position. You have the income statement for H and S. We have additional information. Number one, goodwill is reviewed for impairment annually. As at 30 April 2016, impairment loss on recognized goodwill was Rwandanese francs 42. Number two, during the year ended 30th April 2016, S Limited purchased raw material from H and denominated the purchase in Rwandanese francs in its financial records. The details of the transaction are as follows. So are shown below, sorry. Nature of goods raw material, date of transaction, 1st February 2016. Selling price 60. Profit percentage on selling price 20%. As at 30th April 2016, half of the raw materials purchased was still in the inventory of S. Number three, H Limited issued an interest-free loan to S of shillings 50 million on 1st May 2015. The loan was repaid on 31st May 2016. So they said note 3, H Limited issued an interest-free loan to S of Kenyan shillings 50 million on 1st May 2015. The loan was repaid on 31st May 2016. S Limited included the loan in its non-current liabilities. They are very specific where that loan was included. So number four, the fair value of the net assets of S as at the date of acquisition is assumed to be the same as the carrying value, meaning that there is no aspect of revaluation, because the fair value is the same as the carrying amount. So revaluation arises when there's a difference in fair value and carrying amount of assets. Number five, H Limited paid a dividend of 80 million during the year ended 30th April 2016. Dividends had not been included in the company income statement. We will have to include, have to deduct from profit. Number six, the corporation tax rate is 30%. Its group policy to value and controlling interest at acquisition at its proportionate share of the fair value of the subsidiaries identifiable net assets. The foreign exchange rates are relevant to the financial statement. So you are given dates and rates. So it's all about to understand now what is a spot rate, what is an historical rate, and what is a closing rate based on the dates provided. For which I have explained what is a closing rate, that is what is a closing rate, what is an historical rate, and average, spot, so you know, name them. So required, prepare the following statements in accordance with the applicable IFRS. That is 21. Consolidated income statement, statement of financial position. Step one, we translate, not convert, the income statement. Step two, we translate statement of financial position. Step three, exchange reserve. We do goodwill, and finally we do the required statements. That is the income statement and statement of financial position. So we would like to start immediately. So we do the translation. Then once we are done with the translation, we do what? Once we are done with the first steps, then we do what is required. So I think you have the question. So the first work I will do here is we need to do it very fast because it doesn't earn you any mark. It's like workings which are done. So we do translated income statement. So make sure that you make short notes because I will require these figures from you when doing the relevant statements which are required by the examiner. So we are translating the foreign subsidiary to Kenyan shillings. So under the rates provided, they say Rwandanese franc to Kenyan shillings. They never said one or anything else. So they said Rwandanese francs to Kenyan shillings. So remember that for incomes and expenses, like now the first item under the income statement is revenue. The revenue of 1420 will be translated using which rate? Average. So the average rate is, according to note 8, we have an average rate of 2. So that is what they have provided there. And they mentioned that this is 2. So how will you know that you are supposed to divide or multiply? So when they say this Rwandanese franc to Kenyan shillings, you know that what is given here is this Rwandanese franc. So this is 2 Rwandanese francs to 1 Kenyan shillings. That is what they mean. Diana, the question is November 2016, question 1. You have the past papers, guys. You have been here for long. So I don't have to be sharing one past paper every time. No, I have shared it to the group. So meaning that I was trying to explain about this. What about 1420? So you know that 1420 Rwandanese francs. So meaning when I will be translating Rwandanese francs to Kenyan shillings, I do what? We are supposed to divide. So 1420 divided by 1420 divided by 2. 710. Eh? So you will be giving me these. Give me the answers. So cost of sales. So cost of sales is 960. If you divide by 2, remember that income statement items, the incomes and expenses, use the average. So we have the gross profit here. So 1420 minus, not 1420, because this one already we have it. This one is 460. So 710 minus 480 to 30. Another item to be translated is distribution and admin. So distribution and admin is 200. Divide by 2, we have 100. So this is 260. This is 130. This profit from operations. Eh?
Teacher, even revenue, we are dividing by the average.
Even?
Revenue.
Incomes and expenses. The income statement items use the average.
Okay.
All of them. The income maybe where the need arises. Income statement items use average. Yeah. We have which item? Interest receivable. So we have interest payable because receivable is not on the side of S. We have interest payable. It's 20 divided by 210. Interest payable, it was 20. So we minus, this is 120. This one was 240. So this profit before tax. Then income tax, this is 90 divided by 2, 45. So this is 150. Profit after tax, that is profit for the year. So 120 minus 45, this is 75. So this is step 1. Step 2, so we do the translated statement of financial position. These are just workings. So Rwandanese francs, then the rates, we have Kenyan shillings. So we start from assets, as I can see from that statement. We have property, plant and equipment. It's 1460. So when translating assets, use the closing rate. With the closing rate is the rate which was as at the time when they were preparing their statement of financial position. So statements will be prepared as at the end of the year, which is 30th April 2016. The rate which is given as at 30th April 2016, according to note 8, 30th April 2016, which is the closing date, is 2.1. 1460 divided by 2.1. $695.24. Then investment in S is obvious in the parent. Loan to S is in the parent. We have current assets. So current assets is 1020. Divide 2.1. We have 485.71. 695.24. This is 1180.95. So for the Rwandanese franc, this one was provided. It is 2480. Then we continue with the others. Right now we have equity and liabilities. So for the equity and liabilities, we talk about ordinary. So we have the ordinary shares of the 320. So this one we use historical. Equities use historical. Historical. Who can tell us the historical rate? What does it mean then? You give us the rate. So historical is the rate which was doing what? Which was prevailing as at the date when the subsidiary was acquired. They acquired a subsidiary when? So the foreign subsidiary was acquired some date here. So as at the start of the question, they said H Limited, a public limited company based in Kenya, owns 75% of the ordinary share capital of S, a public limited company based in Rwanda. H acquired S 1st May 2015. So that is the date, 1st May 2015. If you go to note 8, 1st May 2015, the rate given there is 2.5. 2.5. That is the historical. As at the date when the subsidiary was acquired. So 320, you divide 2.5. This is 128. You do the same for share premium. So the share premium is 200. You divide 2.5. This is 80. Then the next item is the retained earnings. So retained earnings, this one you separate it into two. So as acquisition date, so when the subsidiary was acquired, the rate was not the rate. The retained earnings was as at the date when the subsidiary was acquired. You have the question, guys. When the subsidiary was acquired.
1,200 million.
Sorry?
1,200 million.
Yeah, so that is as acquisition, then we talk about post. As acquisition dates.
2.6.
Really? It was that figure. So what you are saying, anyway, let me confirm that. So if you read, I'm talking about as acquisition date, which is same as pre-acquisition. So as at the date when
The rate is 2.6.
I'm not asking about the rate, but the figures.
800 million.
Yes, 800. As at the start of up there, they say the H acquired S on 1st May 2015 for 1,200 when the retained earnings were 800. 800. So this one, 800, you don't use the rate you are saying, but the rate you use is the one which is historical, 2.5. So 800 divided by 2.5. D20. And then you talk about post acquisition. retained profit. So for you to get the post-acquisition, you take the balance carried down minus that balance which was there as at acquisition. So the balance carried down is the balance as at the time we are preparing the balance sheet. So this statement of financial position, it was prepared as at 30th April 2016, as at the end of the year. The retained earnings there is 950, minus this one as at the time of acquisition. Here you get 150. This one doesn't have a relevant rate, but this one would be my balancing figure. What I will get here is the balancing figure. Then here I will introduce something which is not in that statement, but I will have to do step 3, which is an exchange reserve. I will have to do step 3. So again, this one needs a working. Then after that, we have total equity. Then after total equity, we talk about non-current liabilities. So for the non-current liabilities, we have 410. We translate na 2 or 2.1, 2.1. Because we said assets and liabilities. Assets and liabilities, we use which rate? Closing, and the closing is the 2.1. As at the date when we are preparing our balance sheet, the closing. So 410 divided by 2.1, 195.24. Then we talk about current liabilities. So for the current liabilities, we talk about what? 600. So 2.1 divided by 2.1, 285.71. So total equity and liabilities. So for us to get the exchange reserve, we have to do step 3. We have to do step 3. Because once we have that aspect of exchange reserve, for the post-acquisition retained profit, this one will be my balancing figure. So for the exchange reserve, so on translation, so the exchange reserve, we say we translate. So say that translate closing net assets at closing rate. And after we are done with the closing net assets, we translate opening net assets. Translate opening net assets at opening rate. So closing net assets, you know them? Yes or no? The equity. So you go to the statement of financial position. Those are the ones which are as at closing date. Because the statement of financial position is prepared as at the end of the year. So we have 1470. So these are the net assets. So you translate at the closing rate. So 1470 divided by what? 2.1. What did you have? If you take 1470 divided by 2.1, 700. So if this is the closing, and we need the opening. So the closing net assets includes what? Equity, that is ordinary share capital, share premium, and profit. So we have 1470. So what if I need opening here? I will just check profit for the year. I deduct from here so that I get the opening. The profit for the year is 150. Am I correct? You know, we are talking about S. We are talking about S. The profit was somewhere in the income statements. The last item there is 150. That is correct. So you deduct from 1470. That is how you get the opening net assets. So it's all about taking 1470 minus 150. So you get your opening, because if you take this one, you minus 150, you will get the opening net assets. You divide with the opening rate. Our financial year ends on 30th April 2016. So it starts on 1st May 2015. As at 1st May 2015, the rate First May 2015, note 8, 2.5. So divide 2.5 here. So 1470 minus 150. Divide 2.5. That is 528. So these are the opening net assets we have translated. This is the closing. So the closing is higher than the opening. So meaning that it's an exchange gain. Exchange gain. An exchange gain of, so 700 minus 528, 172. So we need to minus what? We need to minus the profit which is already translated. Remember that when we were arriving at this opening net assets, it was inclusive of, so not inclusive. When we were arriving at the aspect of opening net assets, we deducted the 150. And already we know that the 150 has already been translated, or it has already been recognized in the P&L, the translated 150. You remember the bottom line in the income statement. This is the amount which has already been recognized in the P&L. Your URES amount recognized in P&L. So if you minus the 75, so if you take 172 minus 75, what do you have? That is
97.
97. So the 97 is what you are checking to this statement here. to that statement. So give me the balancing figure. So balancing figure meaning that what will appear here under the post acquisition retained profit, because this one is 2480 and this one is supposed to be 1180.95, the same as assets. So if we take 128 plus 80 plus 320 plus 97 plus 195.24 plus 285.71. So now I'm getting 1105.95 minus 1180.95. So the balancing figure would be 75. Then after this step, we said we do what? The next step. We determine the goodwill. So first we have to determine goodwill using foreign currency. Then we translate it. So purchase consideration minus net assets. You raise the share of net assets. So remember that this one is supposed to be, because I've said we do what? We do first using foreign currency. So when they acquired S, the parent paid as at the start of the question. $1,200 Rwandanese francs. That is what they said as at the start of this question, the first paragraph which is there. The net assets of S, ordinary share capital. Remember that we did 75% of the equity, 320. Share premium, 75% of. Remember that you go to the statement of financial position under equity. This is 200.
100.
Retained profit,
800.
As acquisition debt. Retained profit, it has to be pre-acquisition retained profit. Pre-acquisition is the same as the retained profit which was present as at the time that subsidiary was acquired. So 0.75 times 320. This is 240 times 200, 150. And times 800, 600. So 1200 minus 240 minus 150 minus 600. This is 210. This is the goodwill. So translate it as acquisition date. So 210 divided by something there. As acquisition date, as at the date when the subsidiary was acquired, 2.5. Then translate as at balance sheet date, which means that as at the closing date. That is 210 divided 2.1. That is the closing date. 210 divided by 2.5, 84. to 10 divided by 2.1, 100. This is the closing. This is the date of acquisition. So meaning that this one is the closing. Closing is higher than as at the time of acquisition. Meaning that there's a gain. There's an exchange gain of 16. And now generally we need now to know which is the exchange gain. Exchange gain to statement of financial position. So we take the one from net assets, this one, 97, and the one from goodwill. The one from goodwill is 16. So 97 plus 16, 113. But now remember that the parent never controlled the subsidiary 100%. We raise what is going to NCI. 25% of 97. I will not use the total because when I was doing this, when I was looking for this 16 from the goodwill, when we were doing the goodwill, we used the partial method. NCI was never affected. We used the partial method. That is why I'm using 97, not the total. $24.25, so that is what you deduct. 113 minus answer, that is 88.75. So all of these were workings. That is how foreign takes a lot of time. So now I can go ahead and do what is required by the examiner. So what the examiner needs is the income statement and statement of financial position. So who does this? The H Limited. So we do the consolidated income statement. So that is for the year. For the year ended 30th April 2016. So we have shillings in what? According to our question, to make it feasible. So meaning I can push this towards the end. So this is shillings in millions. So we can start from revenue. Remember that when you are doing an income statement, you have to test if the subsidiary was there for the entire year or it was existing for some months. Our financial year ends when? 30th April 2016. It starts on 1st May 2015. H acquired who? S. On which date? At the start of the equation, you are told H acquired S on 1st May 2015, meaning that this subsidiary was existing for the entire year. And so we will be adding the full amount for the subsidiary. We don't have to prorate. So this is 2,000 plus the translated. So if you were to avoid, if you were to avoid some workings and miss some few marks and avoid a lot of work, like now, if I was a student anyway in an exam, I could have avoided the first steps. You can avoid that, but it was only that I was trying to create sense to you that this is what is supposed to be done. You can translate these statements direct without all those steps, but you will miss some few marks, maybe 3 or 4. Because if I was to translate revenue, I can translate it direct without the workings. I will say 14, 20, divide what? I know revenue is translated using
Average.
Average. You know that the average is 2. Then you adjust. You know revenue, you adjust what? You minus what? Intergroup cells. Intergroup cells between H and S is not 2. You have intergroup cells there in not 2.
60.
Yes, those raw materials which were sold. During the year ended 30th April 2016, S purchased raw materials. Those are the goods. So selling price is 60. That is what you minus here. But now we don't have to do this because already we did what we translated. We know that this is 710. We already did step 1. So the same way, you can give me the answer. The same way we can do cost of sales. So the cost of sales, 1200 plus, the same way I could have taken, divide by 2, minus 60 plus what? UPS. Unsold goods times profit margin. This is not something you have to do wrong workings. You know that after, that is according to note 2. After S purchased, did he resell all the goods? In note 2, the sentence which is there in note 2, half of the raw materials purchased were still in the inventory of S. So half of 60, that is 30. Margin was percentage on selling price, 20%. This is 15. Eh? It's all about unsold goods times margin. Eh? So a half of 60 times margin. In the question, I'm told the margin is 20%. This is a fee. It's 15 or what? 15 or 6? It's 15. Cannot be 15.
6. 6.
6, eh? So depreciation overcharge, undercharge is what you adjust there, but we don't have. Undercharge is due to revaluation. Eh? You take your revaluation gain times depreciation rate, or revaluation gain, you divide the remaining useful life. Depreciation overcharge is due to sale of fixed assets, whereby first you need to determine the unrealized profit on fixed assets, and you go ahead to compute for depreciation overcharge. Alright, so again, we don't have to do this because already we translated. So the translated cost of sales was from step 1. From step 1, they already.
480.
Sorry?
480.
480. But so we get the gross profit. After the gross profit, we go towards distribution and admin. 300 plus was 150. The translated, or we take 200 divided by 2. And if there is impairment you introduce here, in note 1 you were told that goodwill is reviewed for impairment annually. As of 30th April 2016, the impairment
distribution cost 100, not 150.
This is a 200 by 200. Correct. Impairment is 42. But now we translate as at this date. This is the date now. This is the rate as this date is, because this is the time when that impairment was given. So they said as at 30th April. 2.1. 2.1 or 2?
It's 2.
2.1. 30th April. Use the spot rate when the transaction occurred. As they said as at 30th April. So use this is the spot. So divide the 2.1. So we have the profit before interest and tax. So interest, finance costs. So here they talked about interest receivable and payable, meaning that the receivable is 40, payable was, the translated payable was, it's all about 20 divided by 2. It was 10. So if we are paying 40, we are receiving 10. See, we just net and have a receivable of 30. We have a receivable of 30. Profit before tax, income tax, 200 plus 90 divided by 2, we got 45. So we have the profit after tax. And we have profit attributable to NCI. And the other one is attributable to parent. This one we do a working. For the NCI, we do a working. The answers, this is 2650. You minus what? 1626. 2650 minus answer 1024. This is 400. This is 20. Minus 420. 604. This is 30. This is 634. 245. So 634 minus answer. Minus not answer, but 245. 389. So we do profit attributable to who? Profit attributable to who? Profit attributable to NCI. So you always know that we start from profit after tax. And we adjust that profit by lessing what? UPS. But only if there was upstream sale. We raise depreciation under, we add over. We raise impairment. But if we use the full method in goodwill, Profit after tax. The translated one is 75. Sell was downstream, because S is the one who purchased. So that one means that the profit of the parent is the one which is overstated, not that of the subsidiary. When it's a downstream, the profit of the parent is the one which is overstated by what the subsidiary never realized. There's no under, there's no over, there's no this. So it's just 75, adjusted profit. So 25% of 75. .25 times 75. 18.75. That is what you put here. 389 minus 18.75. You get what is going to the parent. That is 370.25. So we finish with the statement of financial position. So I can continue here. So H limited. Statement of financial position. As at what? 30th April 2016. So assets. Even this one you could have translated direct if you want to avoid those steps. Like now here there's nothing you could have missed. Because this one you could have scored. Translating even direct by saying parent plus this, but the subsidiary you translate with the relevant rate. There's nothing you could have missed here. Maybe the side where you could miss some 2 or 3 marks is under the statement of financial position. So assets, we have PP, property, plant and equipment. 2970 plus what? For example, you could have said 1460 divided by 2.1. But already we know they translated. We don't have to do this. So the translated was
695.24.
you know the items to adjust here. You add revaluation gain, you minus depreciation under charge. You minus UPFA, you add depreciation over charge. But we don't have. Investment in S, you replace by goodwill. The goodwill which was translated as the balance sheet debt, it was 100 to 10 divided by 2.1. Remember, we got 210 as goodwill divided by 2.1 as the closing debt. 100, 100 minus impairment, So let's talk about the others. The others are right now. I have said investment in yes, you replace by goodwill. Then I can see they are talking about loan to S. So loan to S. Remember that in addition information number 3, you were told that that loan to S was included in the non-current liabilities. So we would have to deduct it at that point. So current assets, $35.50 plus the translated current assets, the translated one
485.7.
was 7.1. So minus 6. Why minus 6? Remember, current assets contains inventory. Under inventory, we always minus UPS and we add goods in transit. That is why I have deducted 6, the UPS, which is always deducted under inventory. If there was things like intergroup owings, which is deducted under receivables, we'll have deducted here. Things like cash in transit deducted under receivable, we deduct, and we add it under cash. So for now, anyway, for the items of current assets and the adjustment we are supposed to do, it's just UPS which is supposed to be adjusted there. You know the others based on the other variables of the current assets. So after that, we do what? We talk about equity. So total assets. We talk about equity and liabilities. So ordinary share capital, remember we use the parent, 600. Share premium, parent, 500. Then we have the aspect of retained profit. We do our working. The same way I will introduce non-controlling interest working. Then I talk about exchange reserves. This one we did already our working. We said which exchange reserve was supposed to be transferred here. I remember we did the one for goodwill and net assets. We combined it and deducted the one which was going to the NCI. The balance was
16.
8.
sorry,
16.
88.75.
and current liabilities we have 300 plus 410, and we minus the 50, the loan, which was included here. You know that they are not supposed to owe each other in the next financial year. But now, since they were specific that where this loan has been included, that is where we deduct it. We always know that when we are disregarding loans or the outstanding balances by the end of the year, it always affects receivable and payables. But for this question, they were very specific that this loan to S has been included in the non-current liability. That is where I have deducted. We disregard it as guided. Current liabilities. $20.50 plus the translating. The translated was guys, you are tired, eh?
285.71.
85.71. Total equity and liabilities. Let's do the workings as you do the summations for the others. So let's do the retained profits, then NCI. So balance brought down, H and S. Add the profit attributable to parents. You raise the dividends paid by who? By parent. So the profit was dividends paid by parent is 80. That is according to additional information number. There's somewhere they mentioned additional information number 5. H paid a dividend of 80. The profit attributable to the parent was the last item in the income statement.
370.25.
Balance drawdown for H. What about for S? S was acquired when? As at the start of the year, so this is 0. If it was acquired in the current year, it cannot have a balance drawdown because the balance is brought down that just forwarded from the previous year. S was acquired just at the start of this year. There's nothing which has been brought forward from the previous year. For H, we have profit at the end, which is 36. As per the balance sheet, we have the profit for the year from the income statement, 340. But this is before they deducted the 80. Yeah? So we need to deduct this 80. So to get the balance brought down here, I will just take 3600 minus what? 340 minus 80 is 260. So 3600 minus 260, 3340 plus 370.25 minus this. This is 3630 point what? 25. 3630.25. So for the NCI, net assets. So under the translated statement of financial position, go to that part of equity. Take your ordinary share capital, share premium. There was a retained profit for pre and a post. And there is exchange reserve. Add these. Give me the answer. So this is pre-retained earnings, post-retained earnings. Ordinary share capital, share premium, exchange reserve. Under the translated statement of financial position. Add those items. Give me the answer. Those are my net assets to be multiplied with 25%. Goodwill of NCI, we don't have. We never use the full method. Depreciation overcharge, we don't have because we don't have sale of fixed assets. UPS, if upstream sale, the sale was downstream. Depreciation undercharge, we don't have because the sale was downstream. The raw material it's SO purchased. Impairment, again, if we use the full method, we never use the full method, it was partial. Under goodwill, so we don't have that. So in short, what you do, 25% of the total, the net assets, the one I've requested, what do you have? Or one student can give me those figures I add. What about ordinary share capital? It was the translating.
$128.
128 plus
Share premium is 80.
80. 128 plus 80 plus, depends on them. 128 plus 80 plus
320.
320 plus the post retained profit,
75.
then exchange reserve was 80 what? 88.75. Was that the one? Exchange reserve was this?
97.
Oh, it was 97. So give me the total. So 128 plus 8 plus 320. 75 plus 97. You are getting which figure?
700.
700, eh? 25% of 700. 0.25 times 700. 175. So that is my balance here. Balance figure 175. Put it here. All right.
When you change the exchange reserve, it should be 97, not 88.75.
Correct. Remember that it was not only for goodwill. There's that 97 plus the one for goodwill, 16. Then 25% of 97, 24.25. 113 minus 24.25, 88.75.
Volume, the non-controlling liabilities, the non-current liabilities should be 300 plus.
Translated.
Should be the translated amount.
The translated
195.24.
195. So 195.2. This one is current liability translated
285.71.
Mute your mic. Funny sounds from here. So, guys, totals 2970 plus 695. 2970 plus 695.24. This is 3665.24. Current assets 3550 plus 485.71 minus 6 UPS. This is 4029.71. So total assets so this is 77, that is 7,704.95. Non-current liabilities 300 plus you told me this is 195.24 minus 15. This is 445.24. 2050 plus 285.71. 2335.71 plus 445.24 plus 88.75 plus 175 plus 1100. So, is there any issue here? There's something we have not recorded well. Can you add and give me the answer? So, is there any figure we picked? So we have not recorded the retained earnings. 3630.25. So you could have told me that. So 3630.25. If I add with the answer I was getting after adding the others, I think it's okay. So that is the case. That is how you were supposed to do this question for the foreign subsidiaries. For the foreign